everyone, and thank you for attending today's Brightstar Resources Investor Briefing webinar. My name is Nicola Gazzatti of Investor Relations Consultancy Corporate Storytime. Brightstar Resources Limited is a Perth-based gold exploration and development company. Brightstar recently announced a proposal to merge with the Linden Gold Alliance, a gold production company and development company located in the Laverton district of Western Australia. I'm delighted to have Brightstar's Managing Director, Alex Rovira, Chief Operating Officer, Dean Vallve, and Managing Director of Linden Gold, Andrew Rich, with me today to run through an investor presentation. The presentation will then be followed by a Q&A session. So without any further ado, I'm pleased to hand over to Alex, Dean and Andrew.
Thank you, Nicola, and thank you everybody for joining. So what we will walk through today was the presentation released last week with respect to the merger between Brightstar and Linden Gold. As you can see here, the assets are truly synergistic, and where we're at, what we're looking to do is combine Linden's existing operating business, their development stage assets, with Brightstar's development stage assets. So for us, it does deliver a business in the Eastern Goldfields of Western Australia, 1.4 million ounces of resources at 1.6 grams. Importantly, as of this year, both entities are producing companies. We've produced over 20,000 ounces between Linden and Brightstar this financial year to date. And the real value driver for us moving forward is the development stage assets that we do have. So within the Linden stable, that is the Jasper Hills project, located southeast of our Brightstar plant in the Laverton hub, and the Menzies and Laverton projects in the Brightstar portfolio. We have a very real and near-term ambition to be a plus 100,000 ounce producer. We've got the projects and the team and the infrastructure to execute on that. Importantly for us, we are looking at being a low capital producer, low capex into production. So for us, it's probably one of the most important things that we do look at is the ability for these projects to get funded and get built in this current gold market. From a market cap perspective, at the issue price of the placement, we are a circa $65–66 million market cap. We'll emerge with over $20 million cash at bank post-transaction, no debt, for an enterprise value of circa $45 million. So very well placed from a balance sheet perspective to execute on our strategy. We do have the operating Linden second fortune gold mine, which will be cash flow generative. So for us, strong balance sheet, the gold price is in a great environment, and we think this transaction makes a lot of sense and truly is synergistic. Just touching on the transaction as an overview, it is an off-market takeover. The consideration is 100% Brightstar equity. The pro forma ownership will be 62% Brightstar and 38% Linden. That's excluding the placement participants. In terms of the transaction itself and the process, there's significant stakeholder support from the Linden shareholder base. So St Barbara have entered into a pre-bid acceptance agreement for their 19.8% of Linden. In addition, they've also committed to putting in $2 million as part of the capital raising. Linden's other major shareholders have all signed intentions to accept the offer, accounting for a circa another 45–50% of the company. So in terms of the merger execution risk, we are very comfortable that all the shareholder and stakeholder engagement from the Linden camp is all highly supportive of the merger. Everyone can see the synergistic nature and the upside and what this combination actually does deliver. In terms of the capital raising, we announced a capital raising of $12 million in a two-tranche placement. Importantly for us, we see strong support from both sides of the shareholder bases. So with respect to Linden, as I mentioned, you've got St Barbara there participating for $2 million. We do have on the Brightstar register, we've got Collins Street and an existing high net worth Jack Yetive participating quite strongly, and also Lion Selection Group coming in. So of the $12 million raised, circa $9–10 million is going to long onlys, existings, and really supportive shareholders. So as a business, as we're building the share register and working on having supporting members, it's great to see that support coming through for the transaction.
The combined group now has the platform to execute its plan of becoming Australia's next 100,000 ounce producer. And many of these projects that form that plan are mineable ounce projects, low risk, low capex pathways to production. And that's quite a key aspect, particularly the mineable ounces part. There's a lot of projects around Western Australia that are in very early stage development. That's not the case with the Brightstar combined portfolio. When you do combine the two companies together, puts us in an excellent position to capitalise on the geographic location of these assets and providing the flexibility on schedule options as well, with both underground and open pit projects to work with. And this really gives us the critical mass to upgrade and restart the Brightstar plant. The two companies' respective experience building and operating mines ensures a low-risk pathway towards delivery, and combined with that strong balance sheet that Alex mentioned earlier, that's put us on an accelerated growth plan to execute. Looking at the Laverton area in a bit more detail, you can immediately see the value of that Brightstar plant and its central location to the projects that surround it. All these projects are, of course, in the combined group portfolio, which nearly has 1 million ounces at 1.8 grams per tonne. The three feeding projects provide a pathway for a mill upgrade, with all the projects being on granted mining leases, which is quite important. All three projects have previously been mined or are in operation, like Second Fortune, and that really sets us apart because it provides a de-risked mine plan compared to just traditional greenfields mining.
So as part of the merger announcement last week, we did release a scoping study into the Jasper Hills development stage asset. For us, that was an important body of work to actually articulate to the market the value that we can see in the Jasper Hills asset within Linden. We're not just buying ounces, we are buying a near-term development opportunity. So for us, it was important to put that out into the market. And when we combine that with our scoping study that we put out last year, this is from the Brightstar September 2023 scoping study, we can see the opportunity here for a pretty significant producer. Both of these asset bases can be mined and operated concurrently. They are highly synergistic. What it essentially shows is we'll have two mining hubs in Laverton and Menzies, a series of open pit and undergrounds. Some will be operated contemporaneously and some will be done sequentially just to manage the capital requirements. The contemporaneous development, importantly for us, has a really low capital cost of circa $34 million, essentially being the $12 million for the Jasper Hills CapEx and the 22 for Brightstar. This delivers over 450,000 ounces production over 8 years. This actually includes all production from the operating Second Fortune mine. So this is just the development stage assets, and this is without optimizing. This is the existing Brightstar study and the Jasper Hills study. What we are looking at doing now is actually a consolidated pre-feasibility study, putting it all together and really looking at the synergies and ways that we can bring ounces forward and increase the production profile. For example, this Brightstar study last year assumed the processing plant would be refurbed to circa 500,000 tonnes per annum throughput. We are, as part of this PFS, assessing ways of increasing that plant throughput. And if we can take that throughput up towards 1 million tonnes per annum, what that enables for us is to bring a lot of this production forward. Commensurately, we'll see that increase in production profile per annum, and really looking at ways of getting this above 100,000 ounce production, which we think is achievable. Touching on the board and management, so from the board perspective, with the existing Brightstar team, you've got myself and Jonathan Downs as Managing Director and Non-Exec Director, respectively. Andrew will be coming across as an Executive Director, an important value driver of the operating side of the business, and he's got great experience operating Second Fortune, bringing mines into production, both from care and maintenance and virgin builds. Ashley Fraser is the current chairman of Linden Gold. He was actually the vendor of the Jasper Hills projects. Ashley's got fantastic experience in what I would call real world business sense, in the sense that he's operated very successful private mining services businesses. Ashley's got experience with open pit mining contracting. So it's a great skill set for us to have in our business. We've got proven miners, both underground and open pit experience. These are guys that have done it before and have the skill sets to actually execute. We were fortunate enough to have Richard Crooks join as non-exec chairman post-successful completion of the merger. For those on the call that do know Richard, his credibility speaks for itself. He's very successful investment banker and also ex-geologist. Great experience at EMR Capital and Macquarie, chairman of a few other companies, and for us was a really good coup to get Richard to join the team, and someone that I think brings a lot of experience and value add to our team. Touch on the management team. A key member of the team is Dean Vallve, who is on the call. Dean's got 20 odd years experience in the mining industry alongside Andrew. So for us to have two guys of the caliber of Andrew and Dean is a fantastic outcome for this business. I'm certainly of the view that mining companies need to be driven by guys with mining experience, and having Dean and Andrew incentivized and aligned for the success really does position us quite well for executing. It's not just the fact that we've got studies and PowerPoint presentations and Excel docs that say we can do it. We've got guys that have got boots on the ground experience to actually execute. When I look at the sector in general and who we aspire to be in terms of our peer groups in the market, these are what I would term the small scale producers on the ASX, the circa 100,000 ounce and below producers. This is actually about 2 weeks old or a week old, so this number is actually probably increased in light of the gold price. But what it shows is that on an enterprise value, these producers trade at an average of about $4,000 a production ounce. So if we've got genuine aspirations of being a near-term 100,000 ounce producer, you could be expected to trade on an enterprise value, of approximately $400 million. For us, that's where I genuinely see us as a business as we execute on our strategy with the assets and the team that we've got in place and the balance sheet. There is no reason why we can't be executing that strategy. So I think that from a market perspective is where we see ourselves potentially trading, and I suppose that's what success looks like from an equity perspective. Just touching on the timetable and the development, what you can see here is year one is really bedding down the operations, being Second Fortune, really enabling Andrew and the team to have the resources, both financially and personnel-wise, to really optimize and enhance Second Fortune. We see that as the opportunity for an existing mine to be hitting its straps under the group umbrella, and really working towards fast tracking the development timetable. So having Menzies and the Laverton hub of Brightstar with the Jasper Hills project being brought forward towards potential production and going through the studies. So it's a busy first year, really integrating the businesses. And year two is about production and growth. And we would like to be making FID in the first half of next year on the development. And we think that's very achievable. That's in line with what Brightstar's study was. We are part of the way through our Brightstar pre-feasibility study. So what we're doing now is essentially consolidating that and aggregating that process and looking to have that out by the end of the year. Just touching on the timetable here, where we really see this kind of being wrapped up this side of June 30, and in particular the back end of May. As I mentioned at the start of the call, there is significant support for the merger from the Linden shareholder group. So we've got really good line of sight on supportive shareholders that can see the opportunity for us. They can see the opportunity in the consolidated company and the synergies that it does bring. From a use of funds perspective, from the capital raising, you can see it essentially all goes into the ground. So what we're looking at doing is exploration, both in mine at Second Fortune, but also in the development stage assets. So we're looking at commencing some drilling, in the next fortnight up at Menzies, and that particular rig would then roll up into Laverton and continue that program. So really, it's money in the ground. It's trying to move these assets forward so that we can be making the most of this gold price environment. From a capital structure perspective, looking, I suppose, at the pro forma here at the issue price, it was a circa $66 million market cap with 22 in the bank. So call it a $45 million enterprise value. We have put a line item in here for a consolidation that we're looking at doing post-merger. I think it's important for us to I suppose, have an appropriate number of shares on issue and tighten it up from an issued share count. The shareholder support is significant. When I go through our top 20, it's going to own a very large percentage of this business, all highly supportive, all writing checks into this capital raising. Lots of them have been active in the market recently and are still active buying the shares at the moment. It's great to see, I suppose, that buy-in from the broader shareholder base into this strategy.
Yeah, just touching on the Brightstar projects, as Alex has alluded to before, we've got 1.4 million ounces across the Menzies and Laverton hubs. Really need to emphasise this is a tier 1 location. It is the Eastern Goldfields. We've got Kalgoorlie only 130 k's away from Menzies, and a dirt road straight through to Second Fortune as well. So really fantastic location. When you consider both scoping studies, we're nudging 100,000 ounces, excluding Second Fortune, so 91 to 98,000 ounces. The EBITDA of 400 mil at 3,200. Current spot price this morning is about 3,500, which is, you know, fantastic upside for us. And the key thing behind those scoping studies is that $34 million capex. It's 22 mil to turn on the Menzies Gold project, and another $12 million to turn on Jasper Hills, which is really important in this environment. We can turn these mines on and pretty cheaply as well. We're not having to spend hundreds of millions of dollars turning these operations on. Next one, Alex, please. And just talking about the Menzies and Laverton hub in particular, in effect, they are independent of each other. We can run Menzies by itself. We can run Laverton by itself. But within and of itself, you know, in effect, Menzies is well placed to do toll treatment, whether that is up the road to Gwalia, down the road to Paddington on sealed highways. There's even other options such as Mount Ida and Davyhurst on dirt roads. So that could run by itself to establish a camp in town and have just a mining operation. Touching on the Laverton hub there for a minute, we've got the existing camp and hub at Second Fortune, got the operating mine, and the exciting thing for us with Jasper Hills, that development project, we've got a fully permitted haul road to the Brightstar plant. So pretty much as you drive past on the way to Laverton, you see our process plant off to the left there as they're heading towards Laverton. That gives us immense flexibility and optionality as to how we turn these mines on and when and where. And fundamentally, it's a proven ore source strategy. We'll get the high grade underground from 3 underground mines and got the baseload open pit feed from another 3 open pits. So from a development perspective, having the 3 undergrounds, the 3 open pits, plus the operating Second Fortune gold mine, there's a really long-term mine life here that we're really excited to see.
Brightstar have been quite busy monetising their existing operations, which is the Selkirk JV over there near Menzies, which recently completed amidst record high gold prices and, excuse me, had an excellent mine to mill reconciliation, I think producing more ounces and at a higher grade than was originally planned. Brightstar now looking at Selkirk 2.0, which is shaping up to be very similar to the original Selkirk deposit. And currently planning works for development later this year. Over to Second Fortune. We've been in production out there since April 2021, and it's historically produced about 20,000 ounces per year. Year to date, we've done about 13,000 ounces in 3 quarters and expect that we can maintain a similar mining rate in terms of production. And we're in the midst of a transition to an owner-operator model. This is largely to drive up increased margins at Second Fortune. We've got the capability and the experience to be able to do it ourselves, and we're implementing that at the moment. What we set up there at Second Fortune in terms of the owner-operator model will be transferred to our other operations, then the underground out there at Jasper Hills and Yandega later down the track. And it really provides the framework. So we're not starting up these new mines right from the get-go. We've already got established mining operations with systems and procedures, and it makes a very easy transfer and quicker pathway to production in that respect.
Just diving into Laverton more specifically, effectively we've got the baseload feed of Corkscrew Well. That's a 300,000+ ounce resource. In our scoping study, we highlighted how we're going to mine 4 open pits there. We did a diamond drill program there in Q1 this year, got some cracking intercepts. C2W Met 3 and 4 particularly. Looking at Met 3, for example, it was 27 metres at 17, and Met 4 was another 34 metres at touch under 8. So, the gold's certainly there. It's really excited. In some ways, that drilling answered a lot more questions than we were kind of anticipating, but, some real meaningful upside there. Touching on Alpha and Beta, they're both about 100,000 ounces each. Beta's right next to the process plant, and Alpha's about 15 k's away. The other exciting aspect for us is Jasper Hills. The Lord Byron open pit has been mined in the past. That recovered really well, and the Fish open pit, which is now planned to be an underground, they're linked to our Brightstar plant on that fully permitted haul road in great condition as well. The fundamental thing for us is our scoping study was done at $2,750 an ounce. It's now through the roof at 3,500 plus or minus. So this could be a real game changer for us. It is that gold price at the moment, but fundamentally, both of our scoping studies at the Jasper Hills and the combined Menzies Laverton, they're both profitable at lower gold price than the current market today. And as I said, fundamentally, this Laverton project is going to be our company maker effectively, with the support of Menzies through our own wholly owned processing facility, 30k south of Laverton.
Second Fortune, as I said earlier, we brought that out of care and maintenance in December 2020, and first production was in April of 2021. Anova Metals Australia had previously gone in and mined a couple of levels in 2017, 2018, but they'd taken quite a large scale approach to a narrow vein ore body. So large equipment, big ore drives, large stoping. We've since come in, tightened that up using narrow vein specialised equipment, and have done quite well. Second Fortune bringing the stope sizes and grade up to a reasonable and consistent level. We process that ore out through Gwailia's plant in Leonora there under a toll processing agreement, and look to continue that throughout this year. And we've just, as I said earlier, transitioned the mine to an owner-operator out of contract mining, which we intend to transfer to our other operations as we get them up and running. On the exploration side, it's really been untapped, and our focus for the last 3 years at Second Fortune has been the mine itself and making sure that continues and getting a mine life out in front of that. And we really haven't touched the ground around it. There's a number of prospects which we've done some drilling on. All of them have got shallow, high-grade intercepts, and we expect that there's going to be other mines, particularly smaller open pits and potentially an underground, in and around the Second Fortune area once we put the drilling into the ground. All of these tenements that you see here around Second Fortune are all on granted mining leases, so there's a quick pathway to production once we delineate resources on them. Over the Jasper Hills gold project, and the scoping study was quite positive for us. And again, that was run at a $3,000 gold price. And obviously, if we run that today's gold prices, it'll look a lot different. But it's a very robust, low capex project with the Lord Byron open pit, which is going to be quite a large open pit, and the Fish underground, which is a smaller underground, a little bit larger than Second Fortune. Combined, both of those projects will be transported service haulage through to the Brightstar plant on the wholly owned surface haul road that Brightstar own. And that's a key piece of infrastructure in the region, and a lot of people don't understand that. And when you look at it on a global scale in that area, owning that haul road is a significant piece of infrastructure. And there's a lot of people and companies interested in using that, but it's our road to use to get to the Brightstar plant. So significant piece of infrastructure there.
Yeah, just touching on Menzies as well. Effectively, we control about 15 k's of strike of the Menzies shear zone. There's a known endowment of 1.3 million ounces. Historically, about 800,000 ounces was mined at basically half an ounce, 16 grams, I think it is. And obviously, the existing mineral resource estimate of about 500,000 ounces in the ground for that 1.3. In effect, super high grade ore bodies. Yandega down the south there, that went down to 600 meters historically. Our mine plan's targeting 190, so great upside there. And for our recent mining campaign at Selkirk, we're doing the final reconciliations now, but I can report that the ore that went through the Gwalia process plant in a couple of weeks ago, that over reconciled on tons, grade, and ounces, and I think the initial numbers is about a 97.5% metallurgical recovery, which just goes to show that Menzies field, recovers really well. It's a beautiful dirt to process, getting a bit nerdy here. But this is the upside that we see both at Yandega underground and the Lady Shedden open pit system, and the link zone as well, which we're looking into as a Selkirk 2.0 mining model. Talking about Laverton now, obviously you can see on the top right of your screen, that's our wholly owned process plant. It's on care and maintenance at the moment. In essence, that's what GR Engineering did in our scoping study was look at upgrading and refurbishing that to about 500,000 tonnes. As part of our combined pre-feasibility study, we're looking towards a 1 million tonne per annum processing scenario. What does that mean? Obviously, more tonnes through the plant, but most importantly, reduce processing costs on a unit of dollars a tonne basis. Our overall combined resources in that Laverton district is about 15 million tonnes. So you can do the maths on that. It's about 1.8 grams, I think. And in effect, it's a fantastic piece of infrastructure. It's wholly owned, as I mentioned earlier. You know, we're not going out to have to spend 100, 200 million bucks on a brand new plant. You know, it's real, it's tangible. It includes a power station on the left-hand side there, as you can see. Camp, tails dam, all the stuff that we, you know, it's sunk capital. It's a fantastic opportunity, and we're going to leverage that as much as we can moving forward.
Excellent. Thanks, Dean and Andrew. So I suppose in summary, that's an overview of the transaction that we're looking at and the assets that comprise both the Brightstar and Linden portfolios. We do see, you know, this is a de-risked approach to mining. You know, this is not a greenfields development. We don't need to go through the traditional process of converting exploration licenses to mining licenses to try and get something financed in a greenfields build. We've got a year of financing risk and a year or two of construction and commissioning risk. We can be in production relatively in a sharp timetable for a low capital cost approach. So in a rising gold price environment, I suppose speed to market is important, and so is risk. So we think we've got the assets and more importantly, the team in this business on a consolidated basis to execute on that strategy. You know, having the likes of proven operators in Dean and Andrew there to go through the feasibility study into the mining operations is important. You know, we think that the current valuation is relatively modest, as I mentioned, with respect to where we could potentially be. You know, on an EV per ounce in the ground basis, it's still relatively cheap. When you apply a lens of, you know, price per ounce in the ground for mineable ounces and near-term mineable ounces, you know, we think there's significant upside there. I think that's what we're really trying to pursue here is the transition from exploration development company into being a producer. We do see the opportunity for using that Laverton hub for potentially further inorganic opportunities. It is important. That is an important piece of infrastructure for us at the Laverton processing plant. You know, we do have a number of, so 15 million tonnes of resources in that district. You know, there are opportunities there for us to continue to grow that. And I think that's an important part of our business moving forward.
Thank you to you all for your presentation. We'll now move on to our Q&A session. Our first question, and Dean, I will direct this question at yourself. Will the acquisition of Linden Gold fast-track Brightstar's intention to refurbish the Laverton processing mill?
In essence, yes. As I mentioned too before, there's a combined 15 million tonnes of resources in that broader Laverton hub, and it makes a lot of sense to put it through our own plant. With toll milling and ore purchase agreements using third-party mills, you know, you are at the mercy of those providers. And while we are thankful for the providers through Selkirk and Second Fortune, you know, we're going to be the masters of our own destiny, having our own processing plant. And as I said, turning that plant back on, upgrading it towards 1 million tonne per annum is a key plank in our strategy moving forward. And yeah, as I said, it's a no-brainer for us to bring all that, the Jasper Hills dirt, particularly as you literally drive past the Brightstar plant, to bring it into our own plant and turn that back on.
Thanks, Dean. Second question, Alex, this one is for you. Brightstar has now completed 2 major acquisitions over the last 12 months. Are there any more consolidation opportunities on the radar?
Look, nothing specifically outside of my previous comment that it is going to be part of our business moving forward. But I do see inorganic opportunities as making a lot of sense in this gold price environment, and more importantly, in a tough capital markets environment. There's a lot of junior companies out there that are going to struggle for access to capital, for access to recognition from the market. And if we can go down the road of showing opportunities where there's shared upside in the exact same scenarios with Linden, i.e. there's synergies there for us to capture, potentially further M&A does make sense. If we can buy ounces for cheaper than we can discover them, then that's fantastic. With that said, we've got a significant portfolio in our own right within this business. You know, when you look at the exploration history of the Linden tenure, some of the Brightstar tenure in the Laverton hub, there is a significant amount of upside organically just with the drill bit. And I think we showed that with the diamond drilling into Corkscrew Well in February of this year. You know, when we're drilling metallurgical test work holes into an ore body and receiving those kind of grades, you know, for me, it does show that we need to be looking in our own backyard before kind of looking abroad. So it'll be a broad brush approach. I think we'll assess every opportunity on its merits. I think there is a genuine business case here for trying to build something that fits into that 100,000 ounce plus producer when I look at what the market is kind of applying valuations at the moment.
Thank you, Alex. Our next question is also for yourself. Over the next 12 months, Brightstar plans to conduct mining campaigns, exploration, and assess M&A options. How would Brightstar rank the priorities in order?
Good question. So for us, operations is clearly the most important thing, and that's Andrew and Dean's bag with respect to the Second Fortune mine. It clearly is going to be a pivotal part of our business moving forward, is ensuring Second Fortune's operating well, you know, producing cash flow and importantly showing the mine life ahead of it. It's probably something that Linden and Andrew have never really had the ability to do is put a large mine life ahead of it, just with respect to the cost required for drilling that out. So it's something that we're pretty keen on doing so we can articulate to the market what that mine life looks like moving forward. So production, specifically at Second Fortune, is incredibly important. From a development perspective, we do want to get these assets into production as quick as possible. So doing the mine studies well, doing the infill drilling required to ensure that there is a lower risk startup as possible, I think is really important and incumbent upon us as, you know, managers of this business.
Thanks, Alex. Our next question is for Dean. What is the upside that Brightstar sees from the Linden Gold package? Can we expect more ounces from Second Fortune and Jasper Hills above what has been delineated in the scoping study?
Yeah, look, absolutely. You know, Second Fortune to us, you know, does what it says on the tin. You look at the historical records of the past couple of years. It's pretty consistent performance. You know, we look forward to seeing that happen again. Walking the ground in and around Second Fortune, there's so many potential deposits there. You literally just haven't been explored properly, and yeah, really looking forward to getting our exploration team up on there and get the drill bit working. In relation to the Jasper Hills project, you know, one thing I should note is within the fish, within the scoping study, 100% of the material is in the indicator, but there is a fish stage 2 at depth. Again, we're looking at chucking the drills in there very shortly, post-transaction, to effectively get that stage 2 into the mine life and really build that ton profile at fish. And lastly, at Lord Byron, again, you know, what we've done in the scoping study there, it's a staged development profile based on different gold price shells. You know, given this current gold price, it'd be remiss of us not to have a second and third detailed look at Lord Byron and see if we can squeeze out another cutback at the back end. What does that all mean? You know, more tons, more mine life, and unfortunately more work for me to do, but that's what I do it for.
Sounds like a lot of work there for you, Dean. Andrew, our next question is for yourself. How profitable have Linden's mining operations been over recent years, and how confident is Brightstar in the ongoing production profile and profitability of the Second Fortune and Jasper Hills mining operations?
Yeah, so Second Fortune, if you look at a mine gate view, Second Fortune has been cash flow positive and has made a profit over the last few years. Linden Gold has done some activities outside of Second Fortune, which have contributed to our current balance sheet. But when you look at Second Fortune on a standalone basis, it does make money. We are aiming to continue that mine life out past 12 months with the additional drilling that Dean and Alex have both spoken to. And it's really about getting that mine life, that longer continuous mine life for Second Fortune, and start as a base profitable mining operation. If you have a look at the historic figures from Second Fortune, it's been a very consistent grade all the way through, about 3.7 grams. So the grade's not changing around too much. It gives us confidence that the mine life in front of us will be reasonably similar, and aiming to try and continue that production moving forward. Up at Jasper Hills, we did the scoping study based on real-time costs coming out of Second Fortune. So we've got a very good handle on what everything costs to go underground mining. with Ashley Fraser, who's our chairman of Linden at the moment, coming across to Brightstar as a non-exec director. He's got a huge amount of experience in open pit mining and capability. So taking those costs for the open pit side of things and the underground costs from Second Fortune, we're confident that the Jasper Hill scoping study was conservative, and there's a lot more upside to come out of that project.
Thanks, Andrew. Our next question is also for yourself. What is the forecast production from the Second Fortune mine for the remainder of calendar year 24?
Yeah, so we've done 13,000 ounces year to date, and we're aiming to try and continue that same production rate through to the end of the financial year. When you look historically what Second Fortune has produced year on year, it's about 18 to 20,000 ounces. So I can't talk to forward production forecasts, but what we've done year to date versus what we've done historically, I think we're on track to do very similar again.
Thank you, Andrew. Alex, our next question is for yourself. I am a shareholder of Brightstar Resources. Has the company considered a capital reconstruction given the large number of shares on issue?
Yes, so I alluded to that as part of the presentation with respect to the capital structure. We are assessing a consolidation post-completion of the merger.
Thanks, Alex. Our next question is also for yourself. What are the Brightstar's biggest costs post-merger, and what are you doing to manage them?
So the biggest costs in the business will be the Second Fortune mine in and of itself, given it is owner-operator and an operating gold mine. Outside of, I suppose, the mining operations itself, it is just people and overheads. And I'm proud to say that we are a very lean team of people that enjoy working hard. Dean might complain, but we are there to try and build this company into something that's quite substantial and real. So really, managing costs is very important for me. I look at it from a capital markets perspective. I know how challenging in this market raising funds are and getting access to capital. Ensuring that we do maintain our balance sheet strength and really give us the best runway to try and deliver on our goals is very important. So keeping a close eye on those costs is really important.
Thanks, Alex. The next question is also for yourself. Can you talk to us about the company's approach to hedging, particularly in relation to production at Second Fortune, which is currently in operation?
It's a good question. Philosophically, I think when someone buys shares in a company, they're buying it to get access to the underlying commodity. People want to buy access to the gold price. If we hedge that away for any particular reason, you're really getting away from the reason someone actually has to buy their equity in the company. So if we didn't need to hedge, then I would suggest that we would like to maintain maximum exposure to the gold price environment, especially in a rising gold price. If you look at some of our operating peers, historically in the last year or two, there have been some hedge books significantly out of the money, and it is a burden to some businesses. So for us, in this gold price environment, maintaining flexibility is very important. We don't need to raise a significant amount of capital through debt, which quite often comes with hedging commitments and requirements. So because we don't need to raise a significant amount of debt, we should be able to avoid the requirements to put hedging in place that's outside of our choosing. Now, we might look to do some small scale hedging as part of the production to ensure line of sight on the revenue line, but we'll assess that in a case by case scenario.
Thanks, Alex. This is our final question for today, and it's for yourself. Can you go through the path to 100,000 ounces per year production rates and costs associated with it?
Yep. So we are doing the work at the moment as part of this pre-feasibility study, and that'll really delineate what the costs are. I suppose I can talk to what we've articulated in the various scoping studies. So in the Brightstar scoping study, we did look at having an average of circa 40,000 ounces production from our Menzies and Laverton operations. Second Fortune's currently doing 20,000 ounces on average per annum. And the Jasper Hill scoping study we put out was circa 35 to 40,000 ounces. So at a high level, that's how I kind of think about it, is the Brightstar is circa that 40 to 50,000 ounces, and then the balance and more is from Second Fortune and Jasper Hills.
Thank you to you all for today. If you do have any further questions, please feel free to forward them to info@corporatestorytime.com. This does conclude our webinar for today. Thank you to everyone for attending, and thank you once again to Alex, Dean and Andrew for the update.